Hi, Greg Weldon here. I'm your host of Money, Markets, and New Age Investing, and this is Season 2, Episode 9, and I'm going to depart a little bit from our normal type of conversation where it's really focused on global macro, geopolitical, and then how we apply it to the markets and portfolios, and we want to do a little bit more of discussing trading and investing and how you do this and the psychology around it. And I actually used to work with Jack Schwager. He was actually my boss at one time when my metal monitor, which was the product I was doing in the metals at the time, was Prudential's official precious metals research. So he ran the research department there, and I got to know Jack pretty well. And his book, Market Wizards, and then the second book, The New Market Wizards, are must-have, must-read multiple times, because I certainly have. And I'm, decided to kind of go through the book a little bit, I don't know, maybe 2 weeks ago. And all of a sudden I said to myself, this would be great stuff to kind of share with my audience. So I reached out to Jack and I said, do you mind if I kind of redo some of these interview pieces in my podcast? And he goes, sure. He's always just a gracious, great guy, legend in our industry for sure, Hall of Famer, first ballot Hall of Famer. And when you context that with where we are now and an interview I just did literally days ago, where really kind of comparing how things are now to how they were in 2008, and even from a psychological standpoint. And I remember from Market Wizards, all of a sudden, that question being asked by Jack Schwager, one of the great traders that he interviewed for this book. And the question was answered as such that, yes, market changes and you have to evolve. And you evolve as a trader for sure. And if you don't, you're dead. And I've always looked at this as a journey of self-discovery, because this is essentially you're at war with yourself. This is psychology, hope, greed, and fear, all of this. A lot of psychology books, really good to read in terms of your instincts, tapping into that kind of thing, and, reconditioning, because if you think about it, a baseball player can hit the ball 3 out of 10 times, and you would think that's failure. On many measures, that's failure. You failed 70% of the time. You stink, right? Except in baseball, that's good enough to make millions of dollars to potentially be a Hall of Famer MVP. It's the same in trading. You don't have to be right all the time. You don't have to be right 70% of the time. You can be right 40% of the time, assuming that your other math is in line with that, where you're making 3 times plus what you risk on average. So if you think about the math there, it's pretty simple. So in that context, I find it interesting that the way things haven't changed is human nature. And these lessons apply today just like they did when this book was written, which I think was, maybe early 2000s, late 90s, 89 maybe. This could be a 1989 book, actually. I think it is. It is, in fact. Okay, I remember looking that up just before I went on air. I should have known that one. At any rate, the degree to which this still applies to me was fantastic. And that's why I reached out to Jack. He said I could do it. And in the context of the first one we're going to do, it's Ed Seykota. And why Ed Seykota? Because he was the first one that wrote a program to trade, like the first, I don't want to say AI, but programmable trading. And in terms of trend following and quant, he was the original quant. Ed Seykota was a MIT electrical engineering. He went to the Sloan School of Management. All right, and when he went to PaineWebber, he met Michael Marcus. All right, Michael Marcus went on to be a trader and a legend at Commodity Corp. And if you know anything about the business from how this all evolved in the 70s into the 80s and 90s, Commodity Corp was the place to be. It was the pinnacle of think tank slash trading house, making money with brilliant people. But it was about the philosophies around trading, making the optimum move, whether you're a math, ag, fundamental guy, supply, demand. It was a fantastic place. It was electric, it was energy, everyone was, something of their own kind of, unique personality. But the bottom line is that Ed Seykota went on to kind of, read Richard Donkian's, 5-day, 20-day moving average cross, which was like the first technical system, if you will. Of course, Edwin Lefebvre's book, Reminiscence of a Stock Operator, he cited, got it right here on my shelf. It's another must-have book, Reminiscence of a Stock Operator, written, I believe, in 1923, right? And at CC, Michael Marcus met Bruce Kovner, Grenville Craig, Tudor Jones, and the guy I used to work for, Louis Bacon. So I have worked with or have had clients or studied under almost everyone on that list. So to that extent, this really kind of rings true with me with Ed Seykota, because he came to Commodity Corp when I was there for 2 years. When I was there for 2 years, it was up 61% after fees over a 2-year period. One of the top risk-adjusted traders with a max drawdown of 11% over the 2 years I was there in the 1990s. Ed Seykota came and coached us for 3 months. And he was into this trading tribe, he used to call it, and he wanted to see if he could set up tribes at Commodity Corp, but the place was too esoteric to deal with that. But Seykota is a genius. He's a brilliant mind, and he's funny. He's self-deprecating. He's very humble, so he's not someone that's flashy at all. He's just a really, really smart and kind of giving guy. So in the context of this interview, what I want to do is cover a couple of topics. What makes a good trader? Okay, risk management, stops, and how do you deal with drawdowns? What are the rules? All right, how does personality and psychology play into this? Because it does. Gut feel, is that worth anything? How about pattern recognition? And then even talent versus luck. And I think the answers you're going to get here from Ed Seykota are really interesting. So I am going to play the part here in our little play of a little Broadway production here in Palm Beach County, a little Playhouse Theater, right? Where I am going to be Jack Schwager and will be Ed Seykota. All right. So what are the elements of good trading, Jack asks? And Ed replies, the elements of good trading are cutting losses, and cutting losses. If you can follow these 3 rules, you may have a chance. And wow, that is so simple, so cliche, and yet so truly prophetic. I mean, it is the truth. I can tell you from doing this for 40 years and making every mistake in the book, okay, learning the hard way in the trenches, the school of hard knocks, if you will, and doing it for a long time on my own. You don't get to do that without having some value add to the process. So in that context, cutting losses is the biggest single thing, and every bad trade that I look back on and regret is the fact that I didn't cut my losses. All right, you don't cut winners, and that is for me is interesting because doing research too, I get asked a lot. What's your projection? What's your upside here? What do you expected by the fourth quarter? And it's like I don't do that, and it's funny because I get criticized on YouTube for that answer. Like, well, what kind of researcher are if you don't give, you're talking about all this, physics and big picture stuff, but you don't give us any forecasts. It's like, well, it's not about that. It's about, I don't want to put a limit on anything. When you say, let your profits run and cut your losses, that is the pinnacle of the psychology, the discipline, the approach, the methodology, whatever you want to look at it as, that is the peak of what you need to do. When you slice it down, that's the single most important rule. And if you don't do that, you're at risk of blowing up. And I've seen it happen to some of the greats, some of the great minds, and at Commodity Corp too. And what's interesting is, you look at people that, have a 50% drawdown, and you say, well, you're never going to give them money again. But then sometimes you will because of the reason they had a 50% drawdown. I mean, because it's such a psychological game, really kind of playing with yourself. All right, so, that's kind of like the headline for Ed Seykota. Okay, then we start to talk about risk management. All right, so the question Jack Schwager asked: do you decide where you are getting out before you get into a trade? And Ed says, I set protective stops at the same time I enter a trade. Normally, I move the stops to lock in profits as the trend continues, known as a trailing stop. All right. Sometimes I take profit when the market gets wild. This usually doesn't get me out any better than waiting for my stops to close into the price and then the price to come down to the stop, which is really the way it works. But it does cut down on the volatility of the portfolio. Now, I 100% agree. I in fact, when I was reading through this, I agree with every single thing that Ed said. And this is particularly important, all right? Because getting out of a profitable trade is the single hardest decision in doing this. It is easily, and if you ask traders, even investors, and I don't make much distinction between trading and investing. I'm not a trader. I'm not a scalper. I'm not in and out. I'm not looking for 2 days. I want months, if not a year and a half to 24 months, 18 to 24 months to hold a position. I want a long-term trend. That's where the bulk of the money is made, all right? But at the same time, I'm going to be out fast. I'm not holding something that's going to be down big against me. I'm either right or I'm wrong at the point of attack. and I want to have enough money to play several times because I tend to be early because I dig so deep into the macro data. I'm looking at it underground. It needs to be above ground so the rest of the market can see it and react to it. In the context of this, it really is, and I do the same thing. The second I put an order in, and I do 95 to 97% of my initiation orders are market orders. I've learned not to mess around trying to, clip the market for a couple of ticks to improve your performance. While there's certainly been guys that have done that and proven that it can add a lot to performance, it's difficult to do. Really difficult. The bigger risk is missing a major trade, and I don't want that. If I want to own it, I want to own it. I buy it at the market. The only other times I don't use a market order would be if I, think I want to see a breakout or a breakdown to buy or sell short. So I will put a stop order above the market if I want to get long and I want the market to prove itself to me. I'd rather buy strong and sell stronger than buy weak and sell strong. I don't want to buy weak. I want to sell weak. All right. So, but that is I totally agree with that total answer. The third point is, dealing with drawdowns. How do you handle a losing streak? Jack asks. And Ed says, I handle losing streaks by trimming down my activity. I wait it out. Trying to trade during a losing streak is emotionally devastating. Trying to play catch up is lethal. And man, if that isn't so true, it really is. So that's kind of interesting, all right, because it really is. And then you kind of go on to the next question, which kind of feeds into, again, kind of dealing with drawdowns. He says, well, Jack understands that Ed, is a programming guy. Since you're primarily a system trader, wouldn't following a system imply no change of activity during losing periods? And that is true. And that's why some of these systems have their 30, 35% drawdowns, 20, 25, 30% drawdowns, because they don't stop, they don't reel it in when they're losing. So it exacerbates the move, in my opinion, all right? So here's how Ed deals with it. I have incorporated some logic into my programs, such as modulating the trading activity depending on market behavior. Still, important decisions need to be made outside the mechanical system boundaries, such as how to maintain diversification when some positions are at their limits in terms of losses or when markets are too thin. Psychologically, I tend to alter my activity depending on performance. I tend to be more aggressive when I'm winning and less so after losses. Those tendencies seem to be okay. In fact, the most costly tendency is to get emotional over a loss and then try to get even with an even larger position. And I think that kind of goes without saying, but a lot of people do it, and I think that certainly in the crypto world, I think that I've heard that mentality. So it's kind of interesting. And for me, it's like a function of the methodology I deploy. Because, I want a theme and then I want to trade mathematically I want to trade technically and then the risk overlays math. So those are the three things. The theme can be geopolitical, it can be, macro monetary, it can be fundamental supply demand, it can be event driven, natural disasters, whatever it might be. But then I want to trade it technically. I want it to be in a certain level of trend on various time frames. And then I want to trade it from the mathematical perspective in terms of the risk, of loss and the management. I put my stops in where I'm going to be wrong technically. And then I figure out how much money does that represent. That's my loss. I don't say I can lose $2,500 a trade, even though I do. Now, what does that mean? If I say, okay, our minimum investment's $1 million. If I say my max loss is 0.4, 0.4%. I do that because I might want to give it a try 2 or 3 times. And often it takes the third time, sometimes a fourth time, but I won't go beyond 4. But that's really when I'm very confident. And usually that is a very high probability that it works out. If it's a 4th time, I'm deploying that capital in the same idea, same position, same trade. 0.4 individual initial trade risk is small. It's only $4,000 on $1 million. So if it's a $30 stop, because that's where my algorithm tells me, the trend is no longer bullish and I'm buying it, then I have a $30 stop. That's $3,000 per futures contract. I can only buy one. If it's a $20 stop, that's only $2,000. Then my $4,000 of risk capital gets me two lots. But it's not because I want to buy 2. It's because that's where the stop is based on the technicals that tell me that that's where I'm wrong. Back engineer it that way it's way more effective in terms of keeping drawdowns to a minimum, at least in my opinion. Now, in terms of rules, and this is interesting since he's a system guy, Jack Schwager wanted to get into the rules a little bit, okay? So what are the trading rules you live by, asked Jack. And this is, I studied with this guy for 3 months. We did all kinds of tribal kind of, exercises that were interesting. And, everyone at Commodity Corp, all the traders had pretty much, except for the guys that were managing over $100 million, had to take part in this. It was cool, all right? And we learned a lot. And this is really interesting, but this is so Ed Seykota in terms of his answers, because he was kind of goofy in a very funny, endearing way, all right? What are the trading rules you live by? Cut losses, ride the winners, keep your bets small, and follow the rules without question. Oh, and know when to break the rules. And man, if that isn't so true, and so him, in just the way he tries to juxtapose, these alternative conflicts in his answers, because he's that kind of intellectual, all right? So Jack's got to push him on it because, Jack just does a great job in this book. I don't think anyone could have written this book better than Jack Schwager. He was meant to write this book. Your last 2 rules are cute because they're contradictory. But seriously now, which do you believe? Follow the rules or know when to break the rules? And I agree 100% with what Seykota says. I believe both. Mostly I follow the rules. But as I keep studying the markets, I sometimes find a new rule which breaks and then replaces a previous rule. Sometimes I get to a personal breaking point. When that happens, I get out altogether until I feel I'm ready to follow the rules again. Someday, maybe I'll have a more explicit rule for making rules. And that's just brilliant. And he gets into the psychology. I kind of want to stop and talk about that just for 2 seconds, because I think that, again, knowing when to break the rules is important, because you have to evolve because the markets evolve. And to think that the same things that worked 20 years ago that will work now is folly. And this is part of the problem with academics and politicians. All right, you write all these theories that are based on 30 years of history, and all of a sudden things change, and there's no reason these theories should hold true. And yet, this is how policy is run based on these theories. It's one of the dumbest things ever. And this is why I'm so glad that I dropped out after going to a single economics class at Colgate University. I immediately was like, this is gobbledygook, and no offense to the academics out there, but unless you have skin in the game, unless you're in the markets trying to determine the economy and the bigger picture, you don't have a clue, man. You just don't, because you think you know about the markets, and these guys that go on that are like I won't mention names, but some of these really big wig college presidents and all this stuff that talk about the markets that have never managed money. Manage someone else's money, then you can talk about the markets. You don't know anything in terms of what it's like to manage money in these markets and try and really discern what the hell is happening, because if you can't discern what's happening, you won't be successful. And in terms of the rules, you have to really evolve. And I wouldn't say it's like, well, the new rule breaks the old rule. I would say you have to adjust the rules as you go in ways that reflect the adjustments that are taking place in the market. I've recently had to do that by adjusting my stops. Why? Because the markets are so much more volatile in terms of they react to news instantly, so you get very quick movements that digest the news fast, and then you go sideways for a while. And/or they're very whipsaw and very almost schizophrenic. They're polarized because a lot of the data is polarized. So I've had to widen my kind of volatility angle that's part of the risk management as it applies to the stops, because you got to give these positions a little more room, which increases the risk, but also kind of decreases the amount of leverage you can deploy. But we're still happily producing returns that far exceed the rate of inflation and the debasement of your purchasing power in terms of your money. So beyond that, though, this comes down to kind of, the personality versus the psychology. Because he goes on to say, and this is Ed Seykota, I don't think traders can follow the rules for very long unless the rules reflect their own style and personality. Eventually, a breaking point is reached, and a trader has to quit or change or find a new set of rules he can follow that is more aligned with his own belief system. This seems to be the part of the process of evolution and growth of a trader. It's 100% true. 100% true. Okay? I can't be a guy that's going to try and buy every bottom, and be the hero making the major call at the bottom. I'm going to be the guy that's going to let the market prove it's a bottom and then buy it and get the meat of the trend. And that's where my experience comes in versus back to the question about where, the trailing stops. I get out of most of my big profitable positions based on instinct. The stops don't really even play into it because by then there's so much money on the table. The stops are going to be still far away because the volatility's expanded. I don't want to give that much money back. So I have seen enough of these moves to recognize different patterns. One of my talents is pattern recognition and then connecting the dots. And that's why I love the macro, because I can do that geopolitically. I love it mathematically because I'm a math and science geek at heart. But the dynamic around pattern recognition is huge. And it's a big factor in trading, and it's a big factor in playing high-stakes poker, too. The World Series of Poker is captivating me on TV right now. Live, I should be there, but just too busy with work. These markets, I can't be out there in Vegas playing poker right now as much as I'd love to be. But the bottom line here is you have to have, the rules have to meet who you are and that you can follow them because it's kind of your nature. And then you evolve within it. All right. So how about gut feel? Okay. That's actually the question. What about gut feel? Because when you're doing, this systematic trading and, you have all these rules, how important is gut feel is the question from Jack Schwager. It says gut feel's important. If ignored, it come out in subtle ways by coloring your logic. It can be dealt with through meditation and reflection to determine what's behind it in terms of, when you get triggered and things come out in unhealthy ways. If it persists, then it may be a valuable subconscious analysis or of some subtle information within. Otherwise, it could be a dangerous sublimation of the inner desire for excitement and not reflect market conditions. Be sensitive to the subtle differences between intuition and wishing. And that is Ed Sokoda. I mean, I can see his face and there's a little smirk on his face as he's saying that right now, some 25, 30 years later. But it's really, really true. And that gets back to your gut feels important. And if you can incorporate that to some degree, like I do with getting out of profitable positions, you're really way ahead. Okay. Then, two more quick questions before I give a little thoughts on where the markets are right now. All right. Luck versus, what do you say? How important is luck, I think was the question. Let me find it because I'm actually flipping through the book as I do this. How important is luck? Because his answer is just so classic that I have to read this to you. I'm not going to be able to find it. Oh, God, come on. Where is it? Where is it? Important is luck. How much of a role does luck play in trading success? Luck plays an enormous role in trading success, says Ed. Some people were lucky enough to be born smart, while others were even smarter and got born lucky. And Jack just hits him right back. How about a serious answer? Well, he says, Ed, luck or smarts or a gift are words indicating an attitudinal proclivity for mastery. One tends to do well at one's calling. I think most good traders have a spark about trading. Some people are natural musicians or painters or salesmen or analysts. I think it's difficult to acquire talent for trading, but if the talent is there, it can be discovered and developed. And that is what Commodity Corp tried to do very successfully with all the people that they did this for. They really did. So that's really interesting. One last quote, though. Jack Schwager asked the most important question, which is, what's the most important advice you, Ed, can give the average trader? And Ed Sokoda, this is just, again, I hate to be redundant, but this is so typical Ed Sokoda. What's the most important advice? That you should find a superior trader to do your trading, and then go find something else that you really love to do. It's freaking brilliant. It really is. Anyway, where do we stand now? Jerome Powell, this week on Capitol Hill, basically, kind of waved the white flag. And when he said that the labor market now poses the same degree of risk, that, the jobless dynamic is really not good. I mean, all the jobs created in the last year have been part-time jobs, 1.8 million versus 1.5 million full-time jobs lost. I mean, so it's really bad. When you talk about the U6, which is the total unemployment rate, went from 7.1 to 7.7 in May. That's 1 month jump on the unadjusted number. I mean, it's a problem. You have 493,000 people dropped out of the equation last month, and the unemployment rate still rose 4.1. Imagine if those people stayed in the labor market and were counted. I mean, the unemployment rate would have probably risen to 4.3, 4.4 maybe. I mean, so that was a bad number. The ISM number also was horrific because the service sector has been the real strength in the economy, and now it's deflating big time. New orders just have collapsed in the last 2 months, right in line, by the way, with the total cocooning in the consumer. I mean, so you're talking about, delinquency still on the rise. Retail sales are still negative on a real basis compared to the inflation rate. And when the price-adjusted numbers are, the price increases are more than the increase in the volume, in the dollar value of sales, which tells you people are spending more money to buy less stuff. I mean, that's really, damaging to the psychology. But when the service sector meltdown, a housing and mortgage market meltdown, I mean, existing and new sales are breaking multi-decade uptrends. Permits and starts are breaking uptrends back to 2009. The mortgage numbers are as low as they've been since the 1990s, outside of just recently, than when they were a little bit lower than they are right now. I mean, CPI was 2.975. It's actually below 3. And then Powell comes out and says the labor market is just as much of a risk of inflation, signaling a rate cut, probably September. The problem is the Fed funds forwards are already pricing in 3.75 for the end of next year. That's down from 4.5 just weeks ago. That's 7 rate cuts in the next 18 months, 17 months. And right now you could say that a fair, still kind of neutral to somewhat restrictive policy rate would be 4%, 3.5 at worst. So there's no real VIG. In a best case scenario, the Fed gets to 3.5, 375 is already priced. What is there? For the stock market especially. And what happens? Profit taking in the high-flying stocks and rotation of capital out of those stocks, all right, big time. On balanced volume, the oscillator rate of change. I've been talking about the XLK and how extended and vulnerable it was to a profit-taking move. The XLK is the Infotech ETF from the S&P 500 sector indexes. And if it takes out $222 per share, that would be a major breakdown, and it would be significant. What's interesting about this is what you're getting is a rotation, into financials. Number one, crypto got a lot of inflow last week, even though, prices, Bitcoin and Ethereum didn't do that great. A lot of other stocks there. Small cap, and the Russell 2000 had its best week since 2021 and is breaking out, all right, after being demolished on a year. It was down year over year, whereas the Magnificent Seven were up 47%. The other 493 S&P 500 stocks were up 7%, and the Russell was down 1%. You're flowing into all the rest of the market. The problem is when this tends to happen, it tends to mark an end, not a beginning of something bigger picture to the upside. What I find interesting to me is 2 things. Number one, in that vein, of course, I like real estate, and I said this in my portfolio playbook 3 weeks ago, the XLRE, and it took off this week, all right? Because once they start cutting mortgage rates, you're going to have a whole nother round of housing inflation. The prices are going to go back up, because you have demand, you don't have enough homes. I mean, it's really that simple. When you make it more affordable by cutting rates enough, the question is how much do you have to cut rates? You got to get them to 6, maybe below 6, depending on the average mortgage rate, and you start doing all these calculations. You need some degree of rate cuts to get there. So it's not going to happen overnight, but that's going to happen. The XLRE is already showing us. And I also said the MBB, as in Mary Boy Boy, is the mortgage-backed securities ETF, which also would benefit, and that also broke out, gapped up this week. The other thing on my mind is the accelerated push to create a new currency for trade among China, Russia, and the BRICS nations. The BRICS unit is what is now being called. There's been meetings all over the world in the last 2 weeks on this. There's a big summit coming in October on this. Even the Asian trade partners, which is ASEAN, the group of trading partners in Asia, the former Asian Tigers, are meeting now to potentially join. All right. You also had, Hungary. Now holds the presidency of the EU. Well, Orban is a Russian sympathizer. He was in Moscow and then went and visited Xi. Just took the presidency of the EU, and what's the first thing he does is visits Moscow and Beijing. I mean, that's pretty interesting. And, Hungary's already kind of been siding with Russia the whole time because they get 100% of their energy from Russia. Oh, not quite, almost. And in that context, the Czech Republic joined them, and certainly the far-right faction from the Austrian government joined them. So you already have the EU splintering here. So this is going to happen. China, in terms of this, is the biggest trader, in the world every month, 300 billion plus. The U.S. is second at 200 billion plus, and no one else is even a close third. I mean, so having a BRICS currency where it includes South Africa, Brazil, even African countries, when you're talking about, all the trading partners would be involved, including India and Russia. That side of the world versus this side of the world is happening. And when you talk about the BRICS, this is why China has dumped over half of their treasury bonds and purchased about 4,000 tons of gold in the last 3 years. The BRICS unit is really bullish for gold. And I just did a special on this, including, and what's interesting is that coincides with what's happening in stocks, because you're going to get a rotation into precious metals here, because the Fed's basically acquiescing to higher inflation. They're basically saying we're going to cut even though inflation is still above our target. I'm telling you, at some point, in not too distant future, they're going to come with a 2 to 3% target range and do away with the 2% target. And you're right in the range, and they could declare victory right now. And that's kind of what they're doing. They're acquiescing to higher inflation. This will be bullish for gold. The BRICS story is very bullish for gold because it's the end of the dollar's regime and reign as the currency of seigniorage, meaning it's used for transacting global trade, particularly petroleum. Of course, Saudi Arabia is involved in this. They have been since the beginning. I've been warning about this since 2018 when they opened in Shanghai a crude oil futures market priced in renminbi using the Dubai OPEC grade crude oil as the contract and got Russia to benchmark their Urals price to that contract. I said then, that's the beginning of the end of the dollar. And when the dollar hits the skids, gold is going to take off. For silver, I'm not one of these, always optimistic, pie in the sky guys on metals. I'm just not. I'll be bearish and short as a drop of a hat if that's the situation. I made money on both sides. And I don't say things like this lightly. I really don't, for sensationalism or for drama or just to make a name for myself. I don't need to do that. I don't really care about that kind of thing. What I care about is, trying to help people. In this case, to me, I really feel like this is a situation where it's not, can silver get to $50? It's the question of how fast does it get to $50? Check me out on Twitter at Weldon Live. Check out the podcast on Twitter at Money_podcast. Check me out on YouTube, Gregory_Weldon. Check us out on Facebook, Money, Markets, and New Age Investing. And if you want to get my special report, it's huge. And I look at gold in a ton of currencies around the world. And bottom line is gold's rising in every currency on the planet right now, and by a large degree. Gold in yen terms has doubled since 2021. Think about that. Email me, Greg Weldon, WELDON, at weldononline.com. Thanks a lot. See you next time.